Hello and welcome to the Rupee Rakshak news of 15 September 2023. This is our fifth episode. I'm your host Raghu Rao, and this week we are going to bring you some latest news and some key information that can help you decide how and where to invest. Rupee Rakshak news is brought to you from the newsroom of FinMo, a SEBI-registered investment advisor. Our financial advice to you is backed by extensive research into the world of mutual funds, stocks, and bonds. Now let's take a look at the global market updates this week. Mr. Tyagarajan joins us from Chennai to share his views and analysis on the global markets this week. Welcome, Mr. Tyagarajan. What is your reading on the global markets this week, sir?
First, let's discuss about the relatively resilient global economy. Global GDP growth is projected to, of course, decelerate to 2.5% in 2023 as low as in 2019. Advanced economies will likely dodge a full recession but will experience low growth in both in 2023 as well as in 2024. The post-pandemic consumers have shifted from buying goods to spending on services, which is dragging global trade as well as related sectors. The US economy remains resilient despite a challenging monetary environment, while the Eurozone grapples with minimal growth with the stubborn inflation issues. As central banks are determined to shake off inflation, the interest rate should remain higher for longer, which will harm highly leveraged sectors and also eventually dampen capex. So about next week's Fed meeting, Fed has gained some traction against inflation, but the inflation problem is far from finished. Fed and the subset category of inflation that the Fed is watching closely, known as the super core, which excludes food, energy, other goods and housing rents, rose 0.4% in August and is up 4%. Considering the US labor market's resilience so far, it appears that Fed has plenty of reason to keep monetary policy tight in the months to come. September probably could be a skip this week, but November could be a hike. About ECB's rate decision. ECB is betting on rate hikes to tame the inflation while the governments continue to spend billions of euros on next generation funds and deficits that imply more taxation or more inflation in the future. ECB might go with a 25 basis point hike today, and the markets would continue to cheer that as a final one, only to be disappointed later. The important story is about the oil prices and the second order impact. It is elevating nervousness as the second order impact on inflation is the key concern. Demand supply balance is coming under pressure. Global demand hovers around 103 million barrels per day, and the supply is close to 101 million barrels per day. The decelerating global growth does not in any way bring down the global demand as the conventional analyst would tend to believe. Any dip is being reportedly bought for refilling petroleum reserves by some Asian names. About global equity markets, expectations for earning growth next year appear too strong, while companies may say margin pressure in the current quarter. Companies could have more trouble passing through price increases to the consumer while their own costs, including labor and raw materials, risk going up more than their revenue. Given the monetary tightening and receding earnings, the stocks are currently richly priced, and S&P should stay between 4,200 4,600 for the rest of the year.
Mr. Tyagarajan, how does this impact the Indian equity investors?
As far as Nifty is concerned, we are caught on the wrong foot, as it broke through all the resistance. You may call it as post-G20 euphoria or India's third giant leap. Structural trends, yes, they do favor the upside, but the cyclical trends are totally on a different wicket. Now it's a momentum-driven market. There is no fear in the market, only greed. In such markets, it's prudent to stay on the sidelines instead of chasing this rally, howsoever it goes up.
Sir, what is your view on the currency markets this week?
As far as dollar is concerned, dollar is quite strong. It goes as per our view. US yields are consolidating at the higher levels. In the current demand-supply dynamics of US treasuries, it is tough for the US yields to come off. And it is highly likely that 10-year yield and Fed funds rate can converge before any signs of easiness develops. So, what I mean to say is, possibly 10-year US Treasury yield going as high as the Fed funds rate. That is our base case view. So as far as rupee is concerned, the higher oil, in whichever way you look at, is negative for the rupee, as simple as this, and positive for the GSEC yields.
Thank you, Mr. Tyagarajan, for your expert views on the global markets this week. Thank you for watching Rupee Rakshak News. Visit rupeerakshak.com and check out our equity portfolios and subscribe to this channel on YouTube.